All right. Good morning from Tampa, Florida, everyone. Welcome everybody from around the world, and let's get started. I hope you like that music. Oh, I got cut off at the very end. Come on, Elon. And he just increased the fees. I pay for the upgraded version so I can edit my tweets, have 60 seconds to undo the tweet, re-edit it, edit other tweets, all kinds of fancy features, and they just charged another couple bucks per month, and I just got booted off. Oh well. So let's get going. Welcome back to Richard. Glad he's back. A lot of things have been happening on Twitter this week. A lot of good stuff to talk about. Then yesterday, more stuff when I was at the hockey game. Absolute got going, and Michael and Richard on stuff I need them to explain to me. And okay, without further ado, we'll get see if Oleg's technology is ready and if he's ready to talk, and we'll let him start us off.
Hi everyone. Hi Jerry. I have showed you only a few seconds ago, but I'm very happy to be here. Of course, I'm now in the forest near the sea. As usual, I get inspired by the nature, and I get inspired by our tranquil and creative pedologist club. So I combine what I love in the same moment. So I'm very happy. And every week, as I always say, every week, every day, every month, and every year, with Trent Poland is happy time.
Rich, you must have a lot of pent up things you want to say. You've been out working like a real man. Uh, when I first started trading, um, we were in the turtle class, and Richard Dennis was like teaching us how to trade, 1983. And one of the funny things he said was, I've never had a real job, but I hear that they're no fun. And if you guys screw this up, you'll have to go back to having a real job. And I kind of knew what a real job was. Even it was just boring, but like no really manual labor necessarily. But I think Rich was actually doing manual labor. At least it looked like that might be what he was doing while he was away from all of us. But yeah, I don't want to do that. It's no fun.
How are you, Jerry? G'day, everyone. Great to be back. Yes, I was doing a bit of manual labour. We're extracting a bit of timber from my property down in New South Wales. So, we're as every good sort of trader who's sort of into lumber, I was actually doing the manual processes of helping getting some of the timber off. But I managed to catch up with your sessions over the last 2 weeks, which I missed. They were really interesting, and I really enjoyed them. And looking forward to a good session tonight. So, hi everyone.
Yeah, so I do trade lumber, and then I also follow some lumber stocks, and they get a little bit of diversification. A lot of the lumber stocks were stronger for longer than lumber price itself. Along with, I follow the shipping futures and some of the shipping companies. Then the shipping futures kind of crashed after a nice uptrend, but some of the shipping companies, cargo, shipping, oil tankers, those things are pretty much, a lot of those are still in big uptrends. So I'm pretty sure your company or what you were doing is not public, but if it was, Richard, I'd be an investor. Good morning, Maurice.
Thanks, Jerry.
Good afternoon. Good morning. How's everybody? Hope you're all doing fine. I just looking at return numbers here, and in 2023, it hasn't been all too much of a good start, to be honest. I think I have one flat day, one positive day, and the rest are losers. So this is how we start the year. Hopefully, better things will come soon.
So personally, I'm interested in the conversation was going on last night with Bruno, Absolute, Richard, ergodicity, and then kind of the idea of using a trade level that's based on something other than current AUM was thrown in the mix. And I'm interested in picking up on that and having you guys explain that to us as to what's going on with your thoughts on that idea, if someone wants to start that.
Hi Jerry, hi everybody. Hope you guys had a great week. Yeah. So I've been reading about this ergodicity thing for a long time, and actually, a few years ago, what started. I've been aware of it because I have a quantitative PhD. I've been aware of it for a very long time, but I haven't really faced it head on, and only was forced to face it head on. Not as a part of any engineering or any physics or any mathematics class, academic class, but it's actually very relevant to what we're doing, to trading and betting. And what a really useful book for me that I read maybe a few years ago. It's a Fortune's Formula by William Poundstone. I don't know if you guys haven't read it. I highly recommend it. It's not going to teach you any new trading strategies or anything, but it's going to make you look at the world a little bit. At least it made me. I thought I knew a lot about statistics and expectations and edge and everything, but once you look at it from that perspective, it will open up, I think, new horizons, and that will include trading, risk management, risk of ruin, and stuff like that. So to explain to Jerry, so what ergodicity is. So it's a statistical term. So ergodic process, random process, is a process for which the ensemble average is equal to the time average of outcomes. So to put it in an example, there are explanations. Even the introduction of the article I quoted has a little introduction. So so basically, I don't know. So you have a coin flip. What I said in the tweet, you have a coin flip, and you make 50% on heads, and you make wait, no, how did it work? You make 50% heads and lose 40% on tails, and so obviously there's a 5% edge on that coin if you know it. So if you constantly just bet on heads, you should be making money because and this is like, there's no, your back test was perfect, there's no curve fitting, there's nothing. You have a coin that's making you 50% when you win and you lose 40% when you lose, with 50% probability, right? And so you have an edge, and you think, oh, with this kind of coin I can make as much money as I can. Who gives you a biased coin like that? So you start flipping, and if you do actually flip it with the percentages, you're guaranteed to lose. Basically, your risk of ruin is guaranteed, as that example showed on the right side curves. But if you so this is an example of a non-ergodic process. So the ensemble average, if you gave this coin to 1,000 people, that's the ensemble. So 1,000 people have this coin, and they'll flip it. On average, the group of 1,000 people is going to make 5% when you average it all out. Some half of them will lose 50%. Some of them will make 50%. Some of them will lose 40%. And on average, the group will be up 5%. So the ensemble will show the expectations of the statistics. But if you give this one coin to one person to flip it 1,000 times, then he's guaranteed to lose. So the expected value of his net worth is not going to be 5% up. It's going to be zero. No, down a lot, basically, as you see on the curves. So that's an example of a non-ergodic process. An ergodic process would be a process in which giving 1,000 coins to 1,000 people, and the average being 5% for the group, is equal if you gave that one coin to one person who flips it 1,000 times, and he will be also up 5%. So the statistics will be reflected. So that's an ergodic process in which the time average equals the ensemble average. And how this is relevant for our business, if on the other hand you gave this coin to one person, let's say, now what's given an ergodic example. An ergodic example with the same coin would be you win $5 and you lose $4 when you lose, with 50% probability, not percent, but let's say dollars, or any fixed amount. So $50, $40, and then whatever. So if you give it to, if let's say the $5 up minus $4 when you lose. So on average, you would, what would that be, like 50 cents. So half a dollar, whatever half a dollar would be expectation. So if you give it to 1,000 people, on average, each of them will make half a dollar. But if you do it yourself also, if you have one person, this one coin, with the $5 win, $4 loss, and he flips it 1,000 times, if he has enough capital, okay, this is a caveat, if he has enough capital, he's almost guaranteed to make 50 cents per flip. 4,000 flips, that's so 50, $5, $50, I don't know, $500. He's gonna make $500. And this, as much as 1,000 flippers with one coin would make 50 cents each, just $500. So a group of 1,000 flippers would make $500, and a single guy flipping it 1,000 times would make $500. Now this process becomes ergodic. So this is an example of the same coin, when you apply it in additive terms, not multiplicative terms. You're not compounding, but you're constantly betting the same thing, regardless of what your capital is. So when you're not compounding, when the process is additive, this last part, it's very different from when you're compounding with the 50% and the 40%. So basically, in the first example, when I gave the non-ergodic example, with the percentages, you're basically risking 40% of whatever your capital is. So that's multiplicative. If you're up, you're risking 40%. If you're down, you're risking 40%. So you get my gist. So my question was, so this is binary. One was ergodic, one was non-ergodic. The first one was you're guaranteed to lose everything, and the second one you have quite good odds to make $500 after 1,000 flips. And my question was whether doing something in between. So when we adjust for our size, as I do, as most funds do, basically, when you're looking at percentages and you adjust your size to your current AUM and whatever, you're doing multiplicative process. So you are moving into a non-ergodic space. So you always have to be careful of, even though if you have an edge, and this is what I've been saying even before, and this is where also Kelly comes in, and this is also the Fortune's formula, because the Fortune's formula is exactly talking about this, the book. So this is when I was saying, even before, maybe 3 or 4 times, you can have an edge, you cannot overfit, you've done everything right, you have some certain edge. But if you trade it in the wrong way, if you trade it in a multiplicative, non-ergodic fashion, you still can have a risk of ruin 100%. So if you go beyond Kelly, twice Kelly, you're guaranteed to lose. You're guaranteed to lose, regardless of what size your edge is. But how you escape this, and why I think how Jerry intuitively is protecting himself from this and has the luxury of not caring about Kelly, is that he's moving away from pure multiplication, and he's kind of doing a hybrid multiplicative or additive process. So with his strategy of adjusting capital very rarely, let's say once a year, let's say just once a year. So you start with fixed capital, your trading level is the same, all your bets are the same. So you're basically flipping the same coin 1,000 times. You're not adding and subtracting like you would do it in a multiplicative fashion. So he's trying to do an ergodic process, an additive process for a fixed amount of time. And then after that time is done, let's say the year is over, then he says, okay, let's see how much money I have, how many closed trades I have, what capital I have. Okay, next year I'm going to do the same additive ergodic process, but with more capital now. Now I'm just going to adjust the level. Instead of adjusting the level on a day-to-day, on a level-to-level, or a more granular basis. So my question was, and I haven't seen a study like this, whether the ergodicity of the process and how it's related with the frequency of adjustment of your trade level. Because obviously, one extreme would be to never adjust your trade level. You start with $1,000,000 and you always just trade what you trade, and you're guaranteed to be ergodic because you're not multiplying. Basically, all your bets are, expecting to make $5, lose $4, make 5, lose 4 with 50% chance, and you do it forever. And as long as your edge is there, you're not exposed to the non-ergodic, to the risk of non-ergodicity. And the next, so basically, of course, that's, I don't know, why would you do that? Like if you, after 1 million, you make 10 million, why would you still trade at 1 million? Eventually you will adjust it. But if you adjust it slow enough, you are exposing yourself to an additive ergodic process. So yeah, my question is, it's not a question, it's just something to think about. And I don't know how many of you have thought about it this way. It just occurred to me that because Jerry is, I think, is straddling these two extremes. One extreme being adjusting your trade level at all times, which makes your process non-ergodic, which means your time average is guaranteed to be different from your ensemble average. And the other extreme is never adjust your level. So Jerry says, yeah, I'll adjust it, but not as often. So what do you guys think?
Yeah, I think I got a lot of that, honestly. So you did a good job. Um, yeah, and I just would say before, I need Richard and Moritz to chime in on this, of course, and Bruna. But I would just say that yes, the reason to do this is not just because of another thing that happens too is if you're going to have a lower trade level that's not going to change very often, then you're going to have a higher unit size. So it's the product of those two, So if I adjusted my AUM every day and I'm making money, the computer would say, oh, you need to trade smaller than you're trading now, because the computer tells me now if you want to make 15%, you've got to trade larger because you're not moving that trade level up and you're falling behind. And so to some degree, it starts out, you're thinking, oh, it's kind of the same thing, it's kind of similar. But what is happening is it's just this obsession with consistently handling each trade the same way as long as you can. At some point in time, we're going to make money. We're going to have this major problem because we're making money, and we've got to change that trade level. Now, one of the caveats I would say to one of your examples of never changing the trade level, I've brought this up before. If I had $50 billion under management and that was enough, and I was making 2 and 20, then I would say to myself, yeah, that's probably enough. What I will do is keep my trade level at 50 billion or whatever. I'll keep it sort of constant throughout the year because I'm going to distribute the profits at the end of each year to the clients and say, hey, do what you want to with these profits, but I can't trade more than 50 billion. So that would be my workaround to achieve the perfect scenario where your edge is never going to be influenced by this random situation of having to change your trade level. So I just see we have this edge. We want to handle each trade the same way, same unit size, same trade level, same entry, same exit. And this is what is going to more ensure that we have this positive edge. Now, if we're using a crazy trade level, the current AUM, then sometimes it will help. We'll make more money, and then sometimes we'll make less money. But why introduce that into a betting system where you're almost guaranteed to win? Let's just say hypothetically. Yeah, you wouldn't want to do that. You'd want to say, take everything out that could possibly impact this edge that we have. Why do we want to introduce things? Well, we don't have 50 billion. We have to move the trade level up at some point in time. And so this is the best thing we've come up with. Okay, someone else take over.
Hey, hi everyone. Hi Jerry. Hi Absolute, Richard, Moritz. Glad to be here as usual. Thanks for the explanation on ergodicity. Absolute, it's a complex subject. I would just like to add one thing. We usually think on ergodicity from a risk of ruin perspective, but it also it also can we can also view it from a positive side. Think about lottery tickets. Lottery ticket is a loser's bet. If you evaluate how much it costs and what's your probability of win versus times the price, it's a bad bet. It's not a good one. And still people do buy lottery tickets. And why is that? Because you have a small probability of win a huge amount of money that will possibly make a change in your life. So back again to that definition you just said, that it's brilliantly put. That's the time average equals the ensemble average when we are in an ergodic process. So if lottery tickets were viewed as an ergodic process, it would make sense to buy to invest all of your money to buy all the lottery tickets you can. But evidently you don't do that, because then you're guaranteed to lose. Whereas if you buy only one lottery ticket, it will mean nothing to you from a loss perspective. It will cost close to nothing. But it has a huge probability of making a difference in your life. So you're okay with buying one ticket. Now back to how that impacts us in our trend following lives. The thing is, from where I see it, is we wish to make this process an ergodic one, because then we are preventing the risk of ruin. And how can we do that is if we make something that will turn our trades through time, the average of trades through time, similar to an ensemble average. I mean, if you were able to take all the trades you're going to take for eternity, for the entirety of your life, and if you're able to take them all at once, then you'll have a big amount of P&L, and you're good with it. But it's not the case. The thing is, you're going to take each one of them one after the other. You cannot take all of them at once. One way to make things closer to that, taking all the trades all at once, is to trade a large amount of markets. Because if you're exposed to a lot of markets, then you're taking kind of an ensemble of trades in a short amount of time. So that's the first trick to turn your trend following system closer to an ergodic one. The second trick is to take time to update your trade level. Because if you're, as I commented yesterday, usually we're taking losing trades. Around 60% of our trades are losing ones. So if you're updating your trade level, if after a big win, the next trades, potentially losers, will mean more to you, will hurt your AUM more than proportionally than that big win you just had. So the trade stats we calculate, the statistics we are expecting to get that convinced us that that strategy was a profitable one will not be exactly that, because if you're updating much quicker, the losses may represent a larger may play a larger role in your results than your wins. So if you don't update your trade level, you're getting closer to you're making your life closer or more similar to that one you found on your back test, on your when you calculated the trade stats of your system.
Yes, Bruno, these were great points. So, yeah, I'm a visual person. I immediately visualized what you just said, and so in to come closer to ergodicity. So to to come to approach ergodicity, basically, we have two weapons. One is diversification, which means, yeah, if you trade, like it's what Jerry is doing, if you trade 300 markets and let's say right now you have 150 bets, so you're already flipping 150 coins at the same time practically, and that's big enough number of coins to flip to give the statistics of your process to show itself. So if you have 150 coin flips over a relatively similar amount of time, your statistics will show, your edge will show. So you're basically your performance will be your ensemble average. You have a big enough ensemble for your statistics to come true. And then when you combine that with a time, so you have on one dimension you have the instrument axis, how many instruments, and then in the other dimension you have the time axis. So if you have enough bets at the same time for that ensemble to show the statistics, and then give that ensemble enough time for the statistics to actually show. Because, so let's say if you have 150 bets now and your average length of bet is 3 days, if you wait 3 days or a week to adjust your size, your trading level, you're basically trading ergodic, because you're giving the chance of all the bets, all the coin flips to realize, to become reality. And then after they become reality, you adjust size, and then you have a new batch of 150 bets that for the next 3 days is going to reflect the next statistics. So the trick here, and this is where science becomes art, and I think there's space here for a paper somewhere. I don't know if anybody has written this, but for me this has been an art, but this could become science, where you can actually have an algorithm or even a formula to tell you how many markets, so how many ensemble coin flips do you need, and to keep your trade level unchanged for how long of a time, to almost approach ergodicity in your process, even though you do adjust your trade level as you go. It's not fixed. So between not adjusting your trade level and adjusting your trade level every second, there is a space somewhere, there's a sweet spot where you get all the goodies from ergodicity, from the ensemble, but you also adjust, you adjust your size, because you do want to compound your wealth. I mean, your end wealth after 10 years, if you start with million.
I think that's already been done. Absolute, like Kelly
Exactly.
criterion was
Yeah.
exactly that. What we're talking about. So, Kelly, what we're talking about here is the difference between an ergodic process. So, when we look at the expectancy formula and we see what that's doing, it's actually an ergodic formula. It's assuming that everything stays constant. In other words, your win rate, your reward to risk remains constant. Now, that's not the reality we find when we are trading a compounded time series. We find that over the course of time, a compounded time series is a non-ergodic process, because we're using a finite capital level and we are multiplying a changing finite capital level over the course of time with effectively an expectancy rate. And so what that does is that it departs from the expectancy ratio. This is why I've got concerns in that the expectancy equation is not path dependent. In other words, it's a simple statistic that does not assume that the sequence of returns matters. It just looks at a global result of those returns, and it assumes that if we have positive expectancy, it's good. But in Ole Peter's example, he was just demonstrating that, say, in the expectancy equation where you've got a 50% win and a 50% loss, and then you've got when you win, you get $50, and when you lose, you get $40. You think that's a good bet. And when you look at the expectancy equation, lo and behold, you get a positive expectancy. However, the reality is that when you adjust that into multiplicative terms, where you're multiplying it against an equity level, so in a compounded series, and you're using a 50% win and a 50% loss, and instead of the $50 or the $40, you're saying, if I win, I get 50% of my prior equity. If I lose, I get 40% of my prior equity. Now, naturally, you'd think that that's the same thing. You assume that that would be a good bet. However, every time you conduct that, you find that every return series deteriorates over time. That's what Ole Peters was showing. And so he was just, saying that the time average departs from the ensemble average when you've got a non-ergodic process with a multiplicative factor. So the problem we're seeing here is that path dependence and it really matters. And that's why ratios, that the Kelly criterion took this into account. They recognized that they wanted to achieve the optimal geometric return as opposed to the optimal arithmetic return, which therefore requires a path-dependent approach. And, the same is what we're dealing here with ergodic and non-ergodic systems. So it's really not telling us anything we didn't know. And I agree with Mike in that it's more an academic topic, because provided we know the difference between a geometric return and an arithmetic return, I think that's the important thing for what we're doing. But how does Jerry compensate for this compounding drag through the non-ergodic series of each of his return streams? Well, he does that through capturing outliers, which are nonlinear anomalies that more than compensate for the drag created by that compounding effect. And that's where I think that's how Jerry's doing it. He doesn't need a Kelly formula to tell him to do that. All he needs to know is that he needs to catch these outliers which have, undefined magnitude, which are many orders of magnitude greater than the linear series. And when you start looking at all of these different formulas like Kelly and all of these things, they're dealing in a world where they're not recognizing outliers. So, they're therefore using position size as a means to, geometrically grow returns. But what we're doing is we're saying, well, in this world we're trading with outliers, there's already these things that are generating our wealth without the need to apply a position sizing treatment. So we're sort of trading what the market gives us as opposed to using a position sizing algorithm to try and sort of manage compounded growth over the course of time. So that's I think, the important thing.
Yeah.
Well, I just want to say a couple other things to throw out there, and I think I have more confidence now that Rich said what he said. But one is, I think that from a trading point of view, I think what you're saying, to put it in kind of simpler terms, is that it's possible. For instance, I'm just saying it's possible. I'm going to choose a low number here. Let's just say for the whole year, you total up all your trades and the net result was you made 20 ATRs on all the trades. However, because of the change in AUM and sizing, you actually lost money. So I think that's kind of what you're saying is, and that's what you want to avoid. It's rare. You probably wouldn't lose money. Maybe you'd only make 10 ATRs, or you could make 40 if you got the change, the randomness of the path, and you got lucky and traded the better trades larger. There'd be the worst trades made some money, but then the better trades, you could trade them larger and they made even more. So I think that is something. And then is this formula or this research that Absolute was talking about, is this, it probably wouldn't be done in the back test, would it? It would probably be done as a formula, or oh crap, I forgot what that other thing is called, but Monte Carlo or something like that.
Yeah, yeah. First, to respond to Richard. Yes, Richard, I understand what the Kelly formula is, and that it's done. What I specifically I have not seen done. If you have a link for this, somebody has done it. You can show me. As I explained, um, so you can trade with fixed size, or you can trade additively, which you will have an ergodic process then. Yeah, that's clear. So we're clear that if you don't adjust your trade size and all your coin flips are the same size, even in probably in dollar terms, as they are in percentage terms, because dollar equals percent when you trade it, trade size is fixed. So if you trade your ergodic process, but if you do that over a long period of time, if you do have a statistical edge, you will not maximize your wealth. The amount of profits that you will make is not as much as you could make, as if you
Exactly. We do want to
do
compound.
want to
You're right.
compound. So
Yep.
now the question is, and I'm assuming for each, let's say a strategy has a 10% edge, whatever it is, 10% or a $10 per coin flip. But there are hundreds of strategies that have a 10% edge. Some of them, they're strategies like us who are diversified, who can have 150 positions at the same time. And then also, even within our space, there's trend followers or systematic traders whose trades, no trades last than more than 5 days, let's say high frequency guys. So or there are people who on average hold for 1 year. So somebody who has a 10% edge and trades on average every 5 days, and somebody who has a 10% edge and trades on average every year. So my question is, what is the frequency of adjustment, of trade level adjustment? How is the frequency of trade level adjustment related to the length of your trade, or whatever, or to your strategy? So for a given strategy, how does one pick the optimal trade level adjustment frequency, whether it's frequency in time or it's by movement, it's granularity? So I've done that experiment for myself for my own strategy, but that's like back testing and with Monte Carlo. It's I don't have a formula for it. That's what I'm saying. Maybe there could be a closed form formula derived, which I have not seen, that can tell you, hey, if X, Y, and Z in your strategy parameters are this much, if you plug in X, Y, and Z in this formula, I will tell you the optimal frequency and granularity of. So it doesn't have to be time. It could be by intensity, how much your PNL changed. Oh, if you're up 15%, you adjust. So basically, I can give you a window. The formula can tell you, hey, the best way, the optimal way for you to maximize your wealth and still kind of be close to ergodic is you adjust your size every 3 months or every 15%. So if you're up 15%, you adjust, move everything up 15%. And if 3 months comes, you adjust too. So you have a window in both intensity and in time. Once you reach one of these boundaries, you adjust size, and you keep doing this for 10 years. You're going to maximize your wealth and be very close to ergodic. So that was my point.
But isn't that what Kelly's doing?
Kelly is not telling you at what intensity and at what frequency to do the adjustments. Kelly assumes you're adjusting every time. Kelly assumes perfect non-ergodicity. He doesn't even assume ergodicity. Kelly says, screw ergodicity. We're going full force. We're going full ergodic, microsecond trade level adjustment. That's what we're doing. Whatever PNL we have now, that's what we're adjusting for the next bet, whatever. And we're going full on. And now we're going to calculate, Kelly says, what is the maximum amount of wealth we can do, knowing full well that if we overdo it, we're screwed. We're bankrupt. We're bust. So Kelly is riding the Bronco. Kelly doesn't care. Kelly says, hey, listen, guys, we don't care. Ergodicity is for sissies. Okay? Ergodicity, we know that, our time average is not going to be the same as the ensemble average. We're fully well aware. But even then, even with that, we know that if we adjust our size at all times, we're going to maximize our wealth. The only thing we need to be careful at what size, at what our bet of our size of our bets are. If we choose the size of our bets correctly, let's say full Kelly will make you the richest, but it kind of increases your risk of moving on the other side of the mountain and then go to ruin. So you go half Kelly, third Kelly, and then adjust at all times. You compound. You're going to be richer than an ergodic guy who doesn't adjust size. But you're exposing yourself to different size of risks. So that's the difference. What I'm saying is, Kelly, and I have not seen, there's no formula that says, all right, maybe just not, let's not do this, guys. Okay, this is kind of dangerous, right? Okay, so how about we try to be ergodic, but also enjoy the benefits of compounding. So for every strategy, this kind of hybrid solution will be different. Every strategy will have a different level of strategy of trade level adjustment that will still keep it safe, close enough to ergodic. So basically the ensemble, you will always give it time, the time average to reflect the ensemble average. But you don't do it forever. Eventually you have to adjust if you want to grow richer and compound your wealth. So what is this frequency and what is this algorithm of trade level adjustment per particular strategy? And this question is not answered by Kelly.
Oh, that's
Well,
amazing.
the other thing you've got to realise is that it's not just the trade frequency. Also, you've got to take into account the difference between your linear losses and non-linear wins, and so you've got to take into account the non-linearity in the process as well. So it's not a sort of this is where I think the issue is.
Okay, I agree. You keep
I was
I agree that for our particular case here, for you and Jerry, where you guys hunting outliers. So whatever I was discussing, this was all referring to pretty well controlled statistics. Like, you win 50%, lose 40%, you win $50, you lose $40. So it's pretty kind of controlled. There's no outliers here. The statistics is known. But even with that all known, this question still exists. The question that I posed. What you're saying is, listen, if I'm hunting outliers, I can basically be ergodic. I don't even have to adjust much size. And I will allow the outliers to compound my wealth. Not compounded by me adjusting my trade level, but my outliers will compound my wealth. Okay, so yes, I like it. I like the idea, but ultimately, even Jerry and you do say, my average win is X ATR and my average loss is Y ATR. So basically, you do have some kind of a statistics. So
Yeah, but this is where I might differ to Jerry. I really have troubles with using any finite statistic, any single statistic to express my my performance. I think is a furphy, because in a non-stationary environment there is no such thing as a single statistic that can express what we're achieving. So, in any a single correlation statistic, a single performance statistic such as a win percent, a single performance statistic such as a return to risk, all of these things I've got real issues with in my non-linear world, if that makes sense.
okay, so you're basically saying that you don't even know your ensemble first moment, second moment. You don't even know, can't say anything about your P&L producing process. Is that what you're saying?
Yes, and this is the key. In our world, in my world, where I'm dealing with outliers, I've got no way of telling you what my expected future returns are. For instance, as soon as I say that, I'm making a heinous error, because I don't know when my next outlier is going to be. It could be anywhere or anywhence. I could be waiting years for it. I've got no idea. So there is no way that I can express my future performance.
So
and this is a problem with.
it could be zero over the next 5 years. Could be zero minus
It
50.
could be. It could be. But the way I'm mitigating this, the way I'm attempting to address this is through maximal diversification with as small a bet size as I can get in my hunt for outliers. So I've got no knowledge when they're going to occur. So when I'm using a backtest, I'm not using a backtest to forecast expected future returns. I'm simply using a backtest to try and break my models. I'm using a backtest to define my risk limitation thresholds. That's it, because I can't make any assessment regarding my profitable components of my future performance, the outliers, that these are unpredictable anomalies to me.
Okay, I don't know. I don't know how. I mean, we're systematic. We're. I don't know how I could trade a system which I don't know what to expect. I mean, I don't even know. So after 5 years, I'm running it. So you're telling me whatever performance it gives me for 5 or 10 years, it is what it is, and the next 10 years are going to be completely different, and I'm just going to keep plugging it and just be as diversified as I can. I mean, what I'm saying, I don't think
No, I'm
diversification
not doing it
solves
that
this.
way. So if you can imagine, I'm not sticking with the same strategy year after year after year. Every year, I'm totally adjusting my strategy. So as new data comes in, as a new year's worth of data comes in, I'm adding that to the 30 or 40 years of data I've got for the time series across all of my markets. So I'm continuously adding data. And the reason what I'm using that data for is to determine my risk thresholds. It's determine what is the level of, so historically, from what history has presented to me, what is the maximum drawdown I've observed over that period? I then ask myself, is that too high or too low? What is the ATR to set my stops at? These are all risk mitigation decisions I'm making for my back test. And that's because I'm using sample size, because I've got a lot of that in my data. What I don't have in my data is big sample size of outliers. I've only got, a few outliers here, a few outliers here, a few outliers here. The outliers are the things that we don't have sample size for. They're undefined. Each one is unique. So I do have information about the risk side of my strategy. So I'm a risk manager. I'm mitigating that risk. I'm leaving myself open to all profit potential. So when I know Jerry hates this statement, but I really like it, is when you take care of your losses, your profits take care of themselves. It really does work, in my mind, in the process that I adopt for that.
And I want to say that our strategy is very adaptive. It's our big benefit of being transformer. I think that it's the key, one of the key, that some things are very constant in our world and some things can be changed. And in this changing things, we are adapting. So we change our initial scope, for example, our position sizes, based on average rate, so on and so forth. So I think and we don't need to make major changes in our systems because of that. If we have a trend following model, so if it's a proper good trend following model, I don't see why we must do some changes.
Oh, if I could just weigh in here. Yeah, so I would slightly disagree with just one thing that Rich said, which is that I don't think about needing to know the expectation of the outliers in the future, and I do obviously realize that there wasn't that many of them in the past, and so what's going to happen with those outliers in the future is right, like he said. I don't know that. However, this is probably something we have sort of gentlemanly disagreed on over the years, and that is that I don't look at it that way because I look at the expectation of all the trades. Oh yeah, I just noticed there's a bunch of outliers in there. Oh, I didn't even notice that. See, that's me pretending. And the expectation per trade, including all the trades and the outliers and the small winners and losers and medium-sized winners, that's what I kind of rely upon in the future. I'm going to have my discretion, not my discretionary, but my rule-based risk reduction, and I'm going to have a conservative trade level, that if that expectation per trade in the future doesn't look like the back test, then I'm going to be able to protect myself pretty well from I'll chop around and make a bit and lose a bit. But yeah, I don't really think that's necessary for us to figure out, well, we can't, and so the expectation per trade, including all the trades, that's how we trick it. We have a large sample size. Let's embrace it. We have 4,000 or 5,000 trades. It just so happens that some of them are large outliers and that represents maybe 5% of all trades. But we've tricked the math gods into, they would have to agree that, oh yes, you don't have to separate those two into a large sample size, and then the other group of trades, the outliers, are a small sample size. Sorry for you. No, it's all one big, huge sample size because we treated each trade the same way, and we can do that. So I think that's the cornerstone of diversified trend following and doing back test. And beautiful explanation about Kelly Absolute. Someone was harassing us on Twitter recently about Kelly, and if only I would have had you. Oh, that was you who was harassing us. Oh, okay. Sorry about that. But maybe we're converting Absolute a bit to our side. So I don't want to push it. Shouldn't have said that on the air. But I'm just joking. I wanted to say, oh yeah, another thing too is we want to set this up, this trade level changes, with a preference for being conservative. So what we want to do is we want to be slow to increase our trade level based upon profits. We want to be slow. We're slow or not as fast as we may want to be much faster at reducing the trade level when we lose money. It's not discretion. It's going to be based on rules, but there's limited information in the back test because we have a great system. We don't habitually overtrade. We're not using aggressive money management. And so we're not going to run into these situations in the back test where we have to do a radical reduction in positions and reducing future positions for a while. We're going to minimize that. It may not even be in the back test. It may just be something we have to do in the future. And then with what Rich was saying as well about, I just had written down as well, we want these outliers to do the heavy lifting. That's a Rich thing. We want them to do the heavy lifting. That's our edge. We don't have to do anything. Just do the system, do the entries and exits. We don't want to be fancy. We don't want to enhance this compound and have it be due to our ability to adjust the trade level in some kind of unique, interesting way. We want to eliminate that actually because we have so much more confidence in our betting scheme, one entry, one exit, and a stop loss, and that's going to do the compounding for us. Rich has already said that.
Yeah, I view when you start overfitting to the past or to historical data, which tends to occur when you are strongly reliant on that historical data for your performance metrics. If you're using that as a guide for the future and you're heavily reliant on your historical data, there's this bias built up that you anticipate the future is going to be the same as the past. I've got a slight issue with that because I know the future is going to be different to the past. So what the back test tells me is not what I'm going to be taking forward into the future. It might give me some information that is useful into the future, such as what has been the typical risk that has been encountered over the past historical environments. But in relation to the total possibilities, they could be anything. And certainly there's a much bigger map of possible future states than there has been on historical states. So the things in the future are always going to be more significant than the things of the past. Your drawdowns are always going to be worse in the future. Potentially, a trend follower's profits are always going to be better in the future simply because of these different environments we've never experienced in the past. So this therefore means you need to reduce your attachment to the back test. But I'm just trying to think why. The reason why I was talking about, I've lost my train of thought. Anyway, keep on going. Sorry.
Hey, y'all. I just had a thought about this. It's almost like holding your trade level constant is a version of volatility targeting, but it doesn't limit your winners in the way that volatility targeting by adjusting positions every day does. Since losses are kept so small in the style of trading like Jerry does, where you're risking a very small amount of capital per trade, you can hold your trade level constant because the effect of those losers as AUM decreases is limited, while not limiting the upside of outlier trades as much. So the effect of that practically is you have a little bit less volatility when AUM peaks and when it troughs. So in my testing, I've found that you come out of drawdown a little bit quicker when you hold trade level constant, because at the trough of a drawdown, your trade size is still the same as it was when you were at all-time highs. But in the same regard, you have a little bit less upside kick when things are going up. So it's almost like volatility targeting, that instead of trying to control the bulk, the middle part of your returns, you can still let your outlier trades have more effect on the upside, but you're not as worried about risk of ruin because your bet size is so small. But you have to do it with a lot of markets, and you have to do it with a very small risk per trade. If you try to do it trading, 5 or 10 markets, risking, 2, 3, 4%, you're going to get yourself in trouble when you have that string of losses in a row. And I think what Absolute Gnosis is trying to say is, with all of these, anytime you're considering any part of any system, you can't just assume the other parts, or every piece of each system needs to be considered very carefully. You can't just take what someone else is doing and apply it to your system, because small changes, either in bet size, markets you trade, speed, all makes a huge difference when it comes to risk of ruin.
Great point, Seth. And look, I've got back my train of thought. The reason why I don't like placing reliance on a back test, so in other words, the reason why I don't use the back test, which tells me that it's best to dynamically position size, is because I believe there is a relationship between drawing too much information from the back test and this concept called fragility, which Nassim Taleb talks about, because I think there is a natural bias that occurs when we start drawing too much on the historical data. We make our systems more fragile, certainly perhaps better performing, in hindsight, looking over that back test, but it makes you less capable of dealing with uncertainty in the future. So the more fragile your model, the less able that model is to deal with future uncertainty when that outcome of sequence of future events, which might be different from the past, don't play out in accordance with history.
I like listening very much, and I like the idea of the words of Jerry that we must take at least as possible from the best, the main thing. And in our strategy, in our philosophy, we always look at the main things in the market, not fundamental, not, but the main thing, the structure of price. The idea that under all circumstances, the price sooner or later will move down or high, it will change, and we will capture this outlier. So I like the idea to take as less as possible from the back end, only main things.
Hi guys. I hope you can hear me well. The conversation is quite fascinating today. So it's very interesting actually. In terms of the backtest reliability, when we speak, it's obvious that we don't rely on the backtest to tell us what the future outliers are going to be, but backtest sets some parameters for us. When we do have these 20 years backtest on my end with minute data, or on your end maybe 40 years with daily data, right? You at least know what your MAR ratio is, and if this year's MAR ratio is a little bit different, you know that sooner or later your results are going to converge to the historical averages. So this applies to your win rates. This applies to perhaps some other statistics. So there is some value in the backtest, and so even though the backtest doesn't tell us what the outliers will be, on a high level there are certain useful things that I think all of us are looking into those backtests. So sometimes we just say the difficult thing and say that we don't want to rely on backtests so much, but there is so much value in the backtests, even trend followers ourselves, that cannot ignore. I think we all agree on this point. No, thanks.
Yes, no, I totally agree with that, Al. My basis for, I did a tweet this week where we were talking a couple of weeks ago. I wasn't there, but you were talking about systematic processes, and you were saying, are there situations where you need to apply a discretionary override? So I pointed out how I view this process, and in those tweets, what I was saying is that I think we were talking about brain versus machine, and I think the brain is very good at conceptualizing models. They don't necessarily conceptualize a reality, but they're very good at conceptualizing models. So when we are constructing our trend following systems, we're using our brain in a discretionary way to decide how we wish to trade these markets. We put a hypothesis to the markets with our models. We're saying, if I adopt a trend following system with this entry, this stop and this trail, this is the model I'm wishing to apply to this market, because my assumption is, the underlying assumption is, that over the course of time, this model is the best way to deal with uncertainty. So that's my hypothesis. Then what I do is I use the data to validate that hypothesis. So the data is essential, and we do get lots of clues from our back test, but we're not getting clues in relation to the outliers because these are anomalous, unpredictable events. But we are getting significant information that we can use for risk mitigation. And so when we enter a trade with our models, we apply all of those known statistics that we are deriving from the historical data set, which at this point in time, we don't know whether we're actually going to be writing an outlier, but at this point of time of entry, we are using the stop and the trailing stop defined by history, because we're saying historical events say that I need an ATR of this, I need a stop at this position, I need a trailing stop at this position. That is the best way to produce linear losses. In other words, to keep the lower bound of my trading model, I want this asymmetry, so I just want linear impacts. I want to restrict the ability of my trading system to navigate towards the left tail. I want to cut off by cutting losses short, and that's where we're drawing all of this information. How do we cut losses short? As far as our letting profits run statement, that is an open-ended question. We've got no data we can use to decide that, but we are just relying on the fact that markets are unpredictable in nature, and there are at times periods that are evident in any liquid market where we get these anomalies of significant non-linear magnitude that creates a necessary asymmetry to complement our linear losses. So it creates this magnificent asymmetry using the market data. We're not using position size as a way to adjust our stance once we take a trade from entry. At the point of entry, we know what we're dealing with, but we're assuming or hoping that we're going to be riding an outlier. So we don't want to do any adjustments from the point of time we've made that entry statement. From that point in time, we're relying on our trailing stops to basically restrict our left tail exposure, but we're leaving ourselves open to any unlimited possibility of profit potential for this asymmetry. You don't need statistics to tell you that. You know that the nature of markets exhibit this leptokurtic profile. We know that there are tail regions in that data. We've just got to be patient and wait for them to occur. We don't know when or where they're going to occur, but they just will occur based on evidence of thousands of liquid market data sets. We know that these events do occur. So we're following price like a glove in recognition that these events will occur. We're playing follow the leader on price. We're not predicting price. We're just following the leader. We're letting the market make the decision. We don't take a preemptive decision to say what price is going to do in the future. We're simply blindly following price with our models. So when I'm doing my back test and I've validated my hypothesis using my historical data that this is where I should have my stops, this is where I should have my trailing stops, that sets a lower threshold boundary of which I'm prepared to endure for my left tail exposure. My right tail exposure is open-ended. So having that knowledge in mind is all I need to potentially have a potentially unlimited profit potential for my models, recognizing that history always manages or mitigates with my system design, mitigates my left tail exposure.
I agree with all that. I think I've been on record as saying that I try to get as little from the back test as possible. I restrict my knowledge on the trade stats, average win, average loss, average trade win percentage, and not try to pay any attention to the equity curve. And I think that I think Michael brought up the problem, and so ignoring everything in between the entry and the exit, those open trade equity drawdowns, and that helps you kind of do those trades and not really worry about them. And you've set the trade level to a low number based upon closed trade equity, and you're not using that trade, the total assets. So the fluctuation that happens when you let those profits run like you're supposed to does not impact your other trades and your anxiety level. Since they're doing the trade level incorrectly, okay, I'm kind of joking here, right? Trying to imitate Cliff. Okay. So then, of course, they need to do vol management. They're doing something wrong on the front end. So they better do something on the back end, and they better start scrambling to reduce those positions or increase them or whatever they're going to do, because we're doing it we're doing it right on the front end, and we're not having to worry so much about the increased volatility. It's certainly a no-no to use a money management tool and talk about it as a money management tool, but actually enjoy it so much because it is just a take profit tool. So, it all sort of begins with the proper trade level, for sure. Well, I wanted to get into a little bit on this stuff that Seth was bringing up. I'll try to remember some of it. I don't think this trade level calculation doesn't have too much to do with. It's not too similar to vol management, other than you don't have to vol management and you can do the trades the way you're supposed to do them and not keep overriding the core system entries and exits because you've got to do this vol management, and you can bury your head in the sand and tell yourself it's a bunch of rules and so that makes it legit. Once again, they're not. They've got to do something because of the mistake on the front end.
Just a quick question. I mean, we're talking a lot about the back tests, but is it possible for someone else just to flesh it out how you're calculating your risk of ruin in your system? Are you using Monte Carlo, or are you using some other process? Because Absolute actually has posted an interesting tweet either this week or the previous week, and the lower the hit rate, the higher the risk of ruin was. So I'm just curious how people are approaching to calculation of risk of ruin, which we didn't talk a lot about in the past.
My thoughts there, Alp, is that risk of ruin is another one of these metrics which we can't rely on. In other words, there is always the chance of risk of ruin on any trading strategy because markets are non-stationary. Markets exhibit these unpredictable anomalies that you can be caught on the wrong side of. Your stops might not always be observed. Risk of ruin is something that is there, but it's not something that I believe can be statistically calculated. As soon as you statistically calculate something, then you're getting to the point of this anomalous sort of single statistic use to say that I expect my strategies over the course of time to not vary or enter different regimes or experience new unpredictable environments. So to me, it's another worthless statistic that I really don't consider. The way I deal with risk of ruin is through my backtest over a 30-year period of my portfolio to examine historically how has it performed. If it has produced profits over the term that I'm happy with a degree of volatility that I'm happy with, that is a tick in my box without having to look to particular statistics, which really are telling me no further information than what something that is a small sample that is highly unreliable.
I mean, it is more of a theoretical exercise, but I would say a trend follower is obsessed with the idea of measurement. All right. So, whatever we do, we have this idea of measurement. We want to measure everything else in our systems. And risk of ruin is just one of that academic numbers that is interesting. And I think it would be nice to see that your risk of ruin is somewhere else between 0 to 1%. It's better if it is closer to zero, but it's definitely not more than 1%. And the question is, are you interested in calculating this? Are you interested in, to know what that number is? And, the way we are running this thing is very different than volatility management. So the odds are using a proper Monte Carlo analysis and making these 10,000, 20,000 runs is difficult. But the question is there. And of course, you were saying that, even though there will be a small chance of risk of ruin, let's say 0.5%, at some point that will materialize. We only hope that it is not going to materialize in our career when running this as well. So that is also another interesting topic. If there is a very small chance of it, does this mean that if we run this thing 100 years, eventually we will see a risk of ruin as well? So that's another line of thought. But I'm just thinking to measure things. So if it is measurable, I would rather measure it with some data, be it imperfectly measurement approach, be it the data would be imperfect and incomplete as well, but at least I do have an idea, and I just like to see that number less than 1%. Thanks.
Yeah, another thing that I've done is that I will go through charts and look at only the outliers. So I will choose parameters that worked on these 5% of the trades without regard to the other 95%. And so I want to see which exits, especially the exits, kept me in the trend, but didn't give back too much profit. And so I'll mess around with those parameters and I'll say, okay, to maximize these particular trades, these are the exit parameters. Given that I'm not going to have multiple exits, if it does this, then I'll do that. But if it does something else, I'll do this. No, I'm not going to do that. I have my one exit. Okay, so then when I apply those same parameters to all the trades, those are the same parameters that work best on all the trades. So to some degree, we are, and so the other trades don't really matter, right? I mean, they did matter somewhat. They buffeted some of our drawdowns, let's say. They didn't turn out to be very much, but we were sort of happy when we had them on and waiting for those outliers. So anyways, I just think that it's okay you don't want to separate the longs and the shorts. You don't want to optimize parameters for different markets or different sectors or for longs or shorts. And I think you can totally ignore in your trade stats that some of the trades were big and some of the trades were inconsequential, and embrace all of those trades and feel comfortable going forward that the right way to handle the little ones, the medium ones, and the large ones is all the same, because that's all the data we have. We have no other data to use except our sample size of historic trades. And one of these days, maybe we'll have millions, or maybe in the afterlife, we'll be able to see millions and millions of trades and see how close we were.
That's a great process, Jerry, because what you're using is a method of exclusion. In other words, you're only focusing on the properties of outliers and you're excluding the rest of the data. So what you're doing is you're excluding 90% of the rest of the data and treating it like noise. So this is where I think a trend follower that is hunting for outliers differs from, say, someone who practices mean reversion. Someone who practices a convergence strategy is dependent on the bulk of that historical data. We are dependent on excluding the bulk of that historical data. So to us, the information contained in a backtest, or, it's only 5 to 10% of it that really matters. The rest is just noise to us or random perturbations. But it is essential for a convergent trader to focus on that. And that's because we're focusing on the unpredictable, the unexpected, the outliers, as opposed to that which can be defined by statistical sample size. So, that's what I think we're doing. It's this method of exclusion. And when we use this method of exclusion, we're not therefore approximating the returns of the entire market. We're approximating the returns delivered by the tail regions of the market data. So as we're diversifying wider and wider and wider, just focusing on the outliers, we're converging to the tail region as far as our trade distribution of returns. The properties of our trade distribution is going to be similar to the properties of the market distribution of returns in the tail regions, and it will not be influenced by the bulk of the distribution of returns, which we've excluded in our process. This is different to diversifying a buy and hold strategy where you approximate the entire market distribution of returns. Our process of exclusion actually converges us towards the tail regions, which is the regions we want to basically dedicate our efforts to, because we believe that the greatest source of returns is through these outliers. That's where our greatest wealth lies.
I think if you just did the back test and you looked at all the trades and you optimized on, and you had a robust system and you optimized on maximizing the expectation, the average trade, and keeping the losses small, and then it popped up, okay, here are the parameters. I don't think that you need to concern yourself that some of the trades were small. The vast 95% of them were inconsequential, and there were 5% that made all the money. I don't think this is, in the sense that this is not a statistical problem. And the future is the average trade will be 3 to 4 ATRs, and that's all you need to know, irrespective of 5% of them made 50 to 500 ATRs.
Yeah, Henrik, I just had a comment to Richard the other day, maybe a couple of days ago, that he agreed that you guys are outlier hunters, where a trend follower is a trader who believes that an up market is likely to go up and a down market is likely to go down. By definition, to me, this is a trend follower. So a trend follower follows the trend. What was the trend? Up. What was it? Is this market up or down? It's up. Then it's likely to be up in the next period. And this market, is it up or down? It's down. then it's more likely to be down. It's likely to be down. That's where probability comes, and that's where prediction comes. Trend following predicts that whatever the market did will do. That's what trend following is. You guys are outlier hunters, like call buyers, put buyers. You don't have to be a trend follower to be an outlier hunter. I understand the philosophy, but and I'm not. This is stupid. This is not. I'm not arguing about who should hold the name. I was from the beginning as I joined this space. Jerry and Richard were exclusionary in the sense that whoever's not hunting outliers is not a true trend follower. Whereas if you really respect the definitions of the words, you can be a trend follower and not be an outlier hunter. As long as you expose yourself to the trend following edict, which is whatever is up is likely to go up, whatever is down is likely to go down, you're a trend follower. That is at the core what being a trend follower is. Richard is also commented, oh, no, not all up markets are likely to go up. Most of the time, up markets are likely to go down because they mean revert or they're just pure noise if they are in the bulk of the distribution. So as long as the market is in the bulk of a distribution on a certain time frame, an up market is not likely to go up. It's either noise, there's no information, or it could be mean reverting, which is where all the mean reverters come in. And also this is how we differ in the sense you can talk about market returns in the distribution, but there is a way to profit from trend following, from this auto correlation in the markets without, if you look at all your trades, like even what Jerry and Richard consider an outlier, and I mentioned this before, there are lots of outliers, 10 ATR, 20 ATR, 30 ATR trades. There is a way to capture that 30 ATR trade with 4 ATR trades. And most of your trades, none of your trades could be not bigger than 4 ATR, but you can still capture these things. The probability of an up market going up may increase in an outlier, but that can be reflected in your system. You don't have to capture it in a single trade and then call it an outlier and be proud of it. So I have these 5% of trades that are huge winners, and everything else is kind of riffraff, like equaling the losses and whatever. And that makes me a true trend follower. A trend follower can be exposed to the market bias of trends in different ways. That doesn't make them non-trend followers. So I understand the whole logic, and I understand Richard's and Jerry's logic. Now that we're especially discussing with Kelly and compounding and how the outlier, you're actually allowing the outlier to do the compounding for you without you having to adjust size. That's a very, very powerful concept. I have to admit, I haven't considered it that way. So if somebody is not exposed to this compound effect on a single trade and is adjusting to volatility and adjusting to that, then he has to compound by making the process multiplicative, and which is exposes you to the risks of all the risk of non-ergodicity. So this is a powerful argument that Richard makes and Jerry makes. I need to think about it some more, but yeah, I just wanted to say that so what trend following is and what outlier hunting is, and not all trend followers are outlier hunters, and not all outlier hunters are trend followers, which I said in the tweet. I just wanted to say that.
Yeah, absolutely. Look, I totally agree with you. And I'd like to call myself a diversified, systematic outlier hunter. That's what I'd like to call myself, because there are so many different definitions of what trend is. So I personally believe that you can find trends in all parts of the market distribution of returns. So what we call a mean reverting element, which is a directional trend that is counter trend, I think is actually a trend. And a lot of, people that say they're mean reverters, well, they're really trend followers. They're entering at a particular point in time at low and wanting the price to go high. There's also random trends you can find in the distribution of returns, which have no positive serial correlation in them. The difference in my lingo is that I'm looking for positive serial correlation. I'm not looking for negative serial correlation. So what I'm doing is, my assumption is based on the fact that I won't be tricked into these trends, which are mean reverting segments that have no enduring potential. Of course, I do get tricked with a lot of whipsaws, but the intent is I want to trade material trends that have positive serial correlation, that gives the momentum that drives that impulse further in that same direction. So the way I'm doing this is through a method of exclusion, where I am saying, all right, recognizing that serial correlation clusters, and recognizing that when you get a period of positive serial correlation, it tends to cluster, I can take advantage of that with a directional trading strategy. But to do that, I need to be fairly explicit when I activate that trading strategy. I don't want to be activating that trading strategy until a price gets material in nature. In other words, I only want to participate in that trend that I'm observing when it gets material. And this is when most mean reverters are saying, oh, the trend's got to end. This is the time I'm entering that trend. So my process of exclusion, when I'm deciding to participate in that trend, is pushing me out to the tail regions as far as my probability density function. So if I'm only dealing with these material trends, I am eliminating a lot of the price movement associated with the bulk of the distribution of returns, and my trade results start converging towards the tail properties of that distribution. So that's when I'm talking about hunting for outliers, my method or my process is deliberately configured to force myself out into this region where I'm targeting a particular type of trend, recognizing that there are these other trends available, which I'm not interested in. I'm focusing on this particular type of trend. Now, I recognize that a lot of CTAs are also taking advantage of trends occurring in the different regions of the distribution. They're taking advantage of counter trend. They're taking advantage of any trend that's found in the bulk of the distribution. And they're doing that through dynamic position sizing. They're doing it through all of these things we're talking about, which to me means that they're not quite doing what I'm doing. I don't wish to be categorized as a trend follower, because I'm not doing what they're doing. I'm doing something different. So I want to be classified as a diversified systematic outlier hunter. I don't want to be mixed in with this other mob that calls themselves trend followers, because it gets very murky. It gets very unclear. What are you actually trying to do? Unless you get under the hood of these systems, there's no way you know actually what they're trying to do. And I think this is the problem in our trend following world, in that when people say that they're a diversified systematic trend follower, it's natural for investors to assume we're all doing the same thing, but we're not. TransTrend is doing something totally different to what I'm doing. All of them, nearly all of them, except a certain few. I'm more aligned with Jerry. I'm more aligned with Mulvaney. I'm doing things more towards what I think they're doing. But as far as the other guys, we're poles apart, even though we all classify ourselves as trend followers.
Exactly, and I think that I'd prefer to be systematic and rules-based and relying upon backtesting as a trader, and then happenstance I just fall into the trend following camp. I think that it eliminate from the numbers and the backtest. I'm not really, and I just get irritated. It's more like I don't want to like classify. I'm not the one who is gonna classify people. I just want to argue and against the managed futures crowd who, is putting out information that I wouldn't agree with. Volatility does not equal risk. It's irritating to see people make less money than they should and have less robust ideas than they should. Yeah. And it's all about sample size and robustness. And are you doing things consistently the same way with all the different trades? That's the problem with vol management, is that I'm all for vol management as long as can be, someone can show me, and which Absolute has already said that he thinks it does not violate sample size issues. But I'm a little skeptical of that. And once again, it still gets back to the same idea that you're going to use current AUM as your trade level. No, that's too risky. You should not do that. You're going to have problems from performance and a staying alive point of view. So it's really just being irritated and seeing, although, if there was one good idea out there, I would completely adopt it. I'm not saying that I can't change my mind. I'm just saying I'm not going to change my mind by the things I see in managed futures. I know, one thing that I wanted to mention, going back to last week, we had this big, long discussion about, I think it was the number of markets to trade, because that's what Niels had come up with on a recent TTU. And that irritates me too, because we've had these discussions many, many times, but they don't go anywhere. They're not respecting our comments, So, okay, whatever. So we had this big, long discussion about it. And then we got to talking about Andrew and the replication of DBMF. And I was defending Andrew and saying, this is great, it's fantastic. I don't know why there's so much negativity. And then, like, right after I got off, like, Seth tweeted something about, well, it was Seth or Brian. It was something like, DBMF is not systematic. And I was like, what? Of course it's systematic. Of course it's systematic. All right, you can be systematic just by following a process and rules. You may not like them, but I think it is systematic. Then he said, it's not diversified. And I was like, oh my, exactly, it's not diversified. I spent 2 hours talking about how important it is to trade hundreds of markets. I totally gave Andrew a pass that he only trades 14 markets. And this is a major problem, only trading 14 markets.
That
Because,
happens to me as well, Jerry. Don't worry.
yeah. So I was just, as soon as I read that tweet, I was like, I was totally wrong. And that in itself is enough to not really defend that type of replication with fewer markets, not because of what they're saying is wrong with it, that it's not going to work. No, it is going to work. In my opinion, it is systematic. He's got great rules. He can do it with 14 markets. The back test says that. He's doing it. He has done it real time. However, in something, and this is a bugaboo of, this is a lot of things. Write this down. If you don't understand what I say or Rich says, it's probably because you forgot one thing that we really say all the time, which is, I'm afraid of the future. It's not in the back test. I get it. Trading those 14 markets is fine in the back test. We don't like that. No. We have to protect ourselves, add things to our system, subtract things from the system, because we're thinking about the future. We're going to be if it never happens in the future, we're willing to accept worse performance, simpler, worse, more volatile performance. And one of these days, and as Rich taught us, it's small bets. That's the reason we want to trade. We are making every outlier smaller as we add markets. But there is no downside to adding markets. You'll just have more of them. Each individual one will be smaller, notwithstanding the fact if you trade 300 markets, you can probably trade a little bit larger overall. But one of these days, one of those 14 could have a really bad left tail, not a bad short, but you could be long and it collapse and vice versa. And that's what we're afraid of. When we trade 60 or 70 markets, we're afraid of it.
there is no downside to maximal diversification, because the smaller you trade, you are not doing anything to the asymmetry. You are still getting the asymmetry of the outliers, and you're still getting smaller losses as you get smaller bet sizes. So the risk reward relationship is staying constant. The asymmetry is staying constant. So all you're doing with smaller bet sizes and diversifying wider is you are increasing your chances of capturing more outliers, because you are less dependent on hindsight bias, and you are accommodating a greater opportunity to get a more outliers more distributed throughout your portfolio time series through maximal diversification. So there is no limit to diversification in our specific world where we're targeting outliers. But yes, there is marginal utility with additional diversification for buy and hold and other methods that are not specifically targeting these outliers. And the reason is, and the good thing on Top Traders Unplugged was that everyone agreed that maximal diversification was the way to go, apart from perhaps Niels, who was talking about the marginal benefits of diversification. But I think Rob cemented the fact that wider diversification is beneficial when you're going for these non-linear outliers in relation to what you're targeting. So, I just see positives in maximal diversification as smaller bets as you can go.
Okay,
And this marginal diversification. So this week I just made a quick test. So I run 2009 to 2019, which is supposedly a bad period for trend following, with single name stocks and without single name stocks. And in my system, the results are much better if I incorporate a good size of single name stocks. I've incorporated 40, usually big brands I have incorporated, and I've used an index to be able to eliminate the selection bias. But yeah, I mean, we are not talking we usually talk about, bonds, the Forex, the commodities, the indices, but adding single name stocks has a huge value into this diversification mix. I'm not quite sure how you're running your back tests, Richard. Are you incorporating single name stocks to your back tests when you do it?
I'm a bit like Moritz. I'm agreeing with you all, but currently I haven't done it. So I'm a bit of a fibber here. I appreciate what you're talking about. I agree with it in principle, but I haven't done it myself yet.
wait, can
But
you? I didn't understand. Did you say adding stocks improved a lot or didn't improve a lot?
improved, significantly improved it. And I've used an index. So I have followed the index constituents when there's a new addition to the index. So I have added in, and when there is a subtraction from the index, I have taken it out. Okay. And so I've said that, okay, I'm going to use the top 40 from this index. So I have also stick to that rule as well. And so I don't think that what I've done is necessarily the best thing, but I've tried to eliminate the selection bias by choosing a worldwide index that's with the major single name stocks into it. And we have discussed in the past that ideally we're supposed to be using small and mid cap stocks, but I have used this index because I have the data already. Number one. So I have the data since 2000, so I'm able to follow it through. And also between 2009 and 2019, I know at the hindsight that S&P 500, the Nasdaq 100, so these indices have done marvelous. Okay, so it was no brainer to go back and add single name stocks that are from those indices. And when I run my system with single name stocks and without single name stocks, with stocks performance is just much better during those periods where we are talking the performance was break even on some of the years, especially between 2015 and 2019. Those 5 years is dreadful 5 years. Basically, it's very hard to take. So I was just thinking, yeah, maybe that this is the way to go. So single name stocks improves the performance. I'm not quite sure apart from Jerry, has anyone else tested single name stocks in their systems? Thanks.
Yeah, I have a question. So I wanted to connect. I was going to ask Jerry to comment on Michael's tweet from maybe a week ago when he tested. I don't know, was it the 5,000 stocks or something, Russell 3,000 or something like that? All of them with a simple 100-day breakout model. And he reported that only 20% were profitable out of the 3,000 of the whole universe. I think it's Russell 3,000. So, so my question is, so Alp obviously, when you, what I also wanted to comment with adding and with diversification. So Alp, obviously you have a very robust system that whatever you throw at it, it adapts and it makes money. And obviously adding more markets or testing on more markets only increases the confidence that you have something that's robust, because if you apply the same system to brand new data and it keeps keeping its head above water and it keeps improving and adding, and then you get the extra benefit, it adds to your diversification. So so my first question for Jerry is that what's the comment on the 20% profitability for a simple breakout system on the 3,000 stocks? Only 20% are profitable. If Jerry ran his system on the 3,000, what percent will be profitable? And whether the 150 that he's running now, were they back tested? Are they all profitable, or they may or may not be? He's just adding them because the future will be different. That's the first.
Oh, yeah, definitely the latter. I haven't back tested them. I'm treating them all the same, like all the other
So
markets.
if you run the test on those, on the 150, and only 20% were profitable over the last 20 years, you wouldn't care.
No, I mean, I would do the test that Michael did, and but I've done those tests, and there is nothing inherent about the stocks where the performance is going to be too much different. I would say that, for the futures markets, currencies, commodities, and interest rates, the shorts are pretty bad. They may make a little bit of money, and I think that stocks are worse. And so I have a universal filter on my shorts that if it doesn't have very much profit potential, and knowing going into it, if you go short based upon the ATR, that it's not going to be anywhere close to an outlier, I limit that and those shorts. So I apply that to all the systems, and it tends to work really well. I mean, to all the markets. I apply that to all the markets, not just stocks. It has a tendency to kick in with stocks more often. Now, and when it doesn't kick in, I do the short stocks. Now, there has been, when we started adding single stocks to the to our trading, we were doing the back testing with the single stocks, and what we found was that the performance was so good that we had to limit the number of stocks we did in the back test because we didn't want the systems to default to choosing the parameters that work best for stocks. But I do think it's a little ironic that you come into this period where two things I want to make fun of. One is we go through this 10-year period or so where the only thing that makes money is being long equities. And then the first question, not from anybody on the call, I'm just saying hypothetically, is do stocks trend? Well, for 10 years, they're the only thing that trended. And before that, they trended pretty well too. The difference was the currencies, commodities, and interest rates trended as well. Number two is the S&P supposedly is a trend following index to some degree. In my opinion, it's a bad trend follower. It's not optimized for the best parameters for trend following, like we would in a back test with breakouts. Thus the question, does trend following work on stocks? My God, how much, just without even doing the research, the answer you would think, of course it does. It's the only thing that's worked. It's worked the best since the 80s, probably in all the markets. The stocks have had the biggest trends. And the stupid S&P that everyone loves, that everyone is long, that everyone has confidence in, it mimics trend following. So does real trend following, breakouts. Will that work? Of course it does. So I think another thing that plays havoc with backtesting is I optimized, and I didn't have a chance to comment on. I agreed with with Absolute totally about you could have 5 trends within a one big trend, and it's kind of the same thing. And so what your look back period in this for your exit or the stop loss size is going to have a material impact on the length of your trades. My average trade is a year, but a perfectly great system could have a look back period of 6 months or 3 months and still make the same amount of money. It just does more trades, as Absolute was saying. But I don't know how Michael did his back test. And if you have a really tight stop loss, then 20% of the trades will make money or less. We used to use a 2 ATR stop loss that is suboptimal for maximizing profit. The win percentage is lower than if you used a 3 ATR or a 5 ATR or a 10 ATR stop loss. So and then people in the office back in that day used a half ATR stop loss. So that's in the 10% range, maybe 5 or 10% of trades are winners. So without knowing how people do their back test, like if I looked at some other person's back test and they said, this sucks, I would say, oh, here's your problem right here. Change that. This is what you're kind of doing wrong. People could do that to me as well. Oh, you're overstating your average trade. Let me show you how you're doing this incorrect. So without knowing what people are doing on their back test, it's really hard to. He did post a couple of trades, and I went back and I looked at the trades, copper and gold, 2 trades that he said lasted the longest, and my exit points entry and exits were pretty close to his, but I really don't know. But those were pretty nice up smooth trends. And so I don't know, the size of the stop loss is going to have a material impact. But still, I think the question was different, which is, do only 20% of the stocks make money? I've never seen that. I've seen the opposite.
So, yeah, since nobody is talking, I wanted to ask you another question. Well, not you, just everybody. The way I converged to my strategy and to my system, it is based on backtests. So I do trust backtests, but the art of backtesting, textbooks and textbooks can be written, and about the pitfalls and whatever. But the way I would choose, for me, the optimal system to trade would be the system that no matter what you throw at it, like no matter what market you throw at it, market condition, regimes and environments, it will keep its head above water and it will survive them. So for me, the steps of adding new markets, and this system will have 2 benefits. One, it will be robust, because whenever you throw it new data, whether it's going forward in time in the old markets or adding new markets with history, with new markets, and with time, it will keep proving its robustness. So it's very hard to trip. And then because of it, you can add all those new markets into your portfolio because, oh, lo and behold, the system is robust enough to handle them without too much change, and you can add them all. So to me, how I measure robustness and how I measure this improves the confidence in my system. And my question to Jerry or Richard is that if somebody, if you were presented with a system that does include some of the things that you are very strongly against volatility management, adjusting size to current size. If somebody introduced you to a system that was more resilient to new data than yours, would you consider it? Like, let's say we compete, you have your system, I have my system, and we pick, I don't know, 3,000 new stocks from all over the world, or any random market, or whatever, any regime or any time, and we start testing them. And this other system consistently, out of the 1,000 new markets, this system one makes money in 80% of the markets, system two makes money in only 20% of the markets without major adjustments. So if this is consistently being shown, would you consider uh, changing your ideology about certain things? Because to me, I have arrived to where I am, not because I was an ideologue about what I must or must not do something, but the process was driven this way. I've been comparing over the 20 plus years, actually now 30 years of testing, comparing one thing versus another, throwing new data, throwing curveballs at it, trying to strip it, trying to break it. And uh, and this is where I've come. So for me, if you say, hey, Absolute, I have this other system that does, it's as robust. It's I throw everything at it. New stocks, new markets, new commodities, new time frames, new whatever. This thing just keeps plugging along. I may consider it. So my question to you is, would you reconsider your ideology if such a thing was presented to you?
Of course, and because my loyalty is not to trend following. My loyalty is to the data. Um, of course, I would, but I think that you're an ideologue just as much as I am, in the sense that we're only ideologues. At least I am only an ideologue in the sense of um, doing a back test, making it robust, understanding when you're going to do things that are not safe and not going to keep you in the game for the long time. All these fundamental risk management principles, math principles that you believe in, you're not going to compromise on those, nor am I. Everything else I'm going to compromise on, but not sample size and robustness. And I'm not an ideologue on diversification, apart from the qualities that the diversification adds. So I don't care about trend following and the way I trend follow, apart from the fact of that I need it to be very robust and have a low risk of ruin and keep me in the game. And then on your first question, though, I would just say that I don't want to mischaracterize how you worded it, but to the degree that any of what you said would make me sort of say, oh, you want me to choose something that shows its merit based upon less data than more. No, I'm an ideologue on using all the data or as much data as possible. No apology for that. But it's all the things that we say we get accused of being ideologues on, and we give people the impression that we are ideologues on them. They're all rooted in something deeper, just in the same way that you have your things that are no compromise. I'm sure you do, because you know more about the data and the math than I do.
Hello, everyone. Hi, Jay. I had some internet problems today. I wasn't able to connect. Do we have a few more minutes? I'm going to say a few things about the back tests for stocks and ergodicity.
Yes. Well, thanks for being here, Michael.
Yeah, well, the back tests with stocks, I don't use an ATR. The problem are the adjustments for dividends and splits. Those, they distort the ATR values significantly. So I use a fixed percent loss. The future back tests probably similar. That's why we got about the same trades in the past for copper and gold. Now, And the back test with the stocks was a rough idea. And of course, it's a Pareto distribution. About 20% of the stocks generate 90% of the gain. And this should be expected. And this is good, I think. Now, referring to the talk about ergodicity, because I was listening from the web, my phone had some connection problems. You know, all systems, ergodicity is like a theoretical, philosophical idea. There are no ergodic systems in real life. There is no such a thing. Only a few, maybe in electrical engineering. Now, all systems are random systems in real life. And I posted a chart in Twitter. Ergodicity is like if you look at the sun, and this is the set of all random processes. Ergodicity is like the moon or Earth. And it doesn't make sense to talk about these things. Academics talk about these things to get tenure credits, and it's not very useful for practical ideologues to talk about ergodicity. All dynamic systems create risk and even chaotic conditions. Even our planet system, our planetary system is chaotic. What is different is what is called the Lyapunov time. Lyapunov time, it's a constant that says how long a chaotic system dynamic takes to become chaotic. And for a planetary system, maybe it's million years, but for other systems like chemical or electronic, maybe a few seconds. For trading systems, it may be a few years. So every trading system at some point will become chaotic, and its experience and the ability to react fast and adjust the system that allows people like Jerry and other very experienced people to stay in the game, trying to make a system ergodic is like trying to squeeze the sun down to the size of the earth. That's a philosophical idea, and all market timers face the risk of ruin if they stay long in the game and they don't make adjustments. Like you say, trade stocks to make the adjustments and stay in the game when the futures they create harsh conditions. And something else I want to say and end this because it's late. You've been 2 hours in this space. This talk about multiplicative and additive process is another false dichotomy the academics have created. If you go to medium.com and look for my name, I have published articles. Most additive systems can be made multiplicative, and most additive systems have shadow multiplicative properties. So it doesn't, to finish with this, trading is practical. It's how you can maximize your profits and cut your losses short. And the other ideas are for the academics. And this is my point. Everyone have a nice weekend, and maybe next time could talk more about these ideas.
Any comments before we close? Absolute. Richard?
Nope, I'm good.
No, all good, Jerry. Good session tonight.
Oh, yeah, very good. Thank you, guys, for staying up late and being with us. I'll try to keep the Elton John songs to a minimum in the future, but welcome back, Rich. And it's been a good session, good time. Keep it going on Twitter. I really enjoy everybody, all the comments. And I wish everybody a happy weekend, good weekend, and I'll see you next week. Thank you.